What the is going on with GameStop? In today's episode, we are going to break down what exactly is going on with GameStop.
After that, we're going to talk about the sky-high private valuations for Calendly and Databricks. Stay tuned.
It is Friday, January 29th. This is the Piper Rundown. We analyze business and culture to help you win. Today's rundown is presented by JetStore. JetStore has been providing affordable, reliable, and easy-to-manage data storage and cloud solutions to over 4,000 customers worldwide for over 26 years. JetStore offers storage systems for private cloud hosting, video surveillance, Internet of Things, AI, machine learning, edge computing, data archiving, HPC, media production, medical imaging, and flight simulations. For more details, visit jetstore.com. Thank you for sponsoring the rundown.
There is no other story remotely close to being worthy of starting today's rundown with than GameStop. In the last day, GameStop saw price fluctuations from as low as $126 to as high as $492. That is an absurd amount of volatility for any equity. But this is a story that has not been days in the making, weeks in the making, months in the making. It has been years in the making. The fairest place to start our story is with the subreddit Wall Street Bets, a community online on Reddit, one of the most popular websites on the entire internet, that even before the start of the pandemic, investors were in there sharing ideas. It was an open forum, much akin to the way hedge funds have idea dinners where they'll all pitch each other their best ideas and then say, hey, let's all go in on this trade together, but in a public, relatively public forum.
Yes.
A couple characters who are pseudonymous in that subreddit came to the same conclusion about a company, GameStop, that they believed had value. This was not a speculation. This was not some sort of, let's turn this into a meme. They saw an enormous amount of value. Number one, because there was an unduly large short position on that stock, and it was a company with a relatively strong cash position, new board directors, including the founder of Chewy.com, a very forward-thinking pet supplies e-commerce company. And some of these characters with some names like Roaring Kitty and Deep Fucking Value went in early when this stock was under $20 a share. In fact, it got as low in April of 2020 when the whole market was crashing, as low as $2.80 per share. As it started to pick up momentum in the wake of that, and as a flood of quote-unquote Robin Hood traders following people like Dave Portnoy, using the free money that came in as stimulus checks, using the fact that they were probably a little underemployed to do more analysis, started piling into this stock, seeing the opportunity for a moderate short squeeze. We're going to explain what a short squeeze is in a moment. But the important note here is that any categorization of this is just an alt-right group or a bunch of uninformed dullards that don't know what they're doing, those are both objectively false. Yes. If you watch the videos that Roaring Kitty has put out, if you read the posts that Deep Fucking Value has put out, these are well thought out breakdowns of why the equity was fundamentally undervalued. And that starts with the exorbitant amount of short positions on the shares outstanding. One of the entities that is leading that short position, but many hedge funds are doing this, is a firm called Melvin Capital. We're going to come back to them in a second, but let's first explain what shorting is and what a short squeeze looks like. Very simply, how does shorting work? It works by trading options. So what a hedge fund will do, or any investor that is trading an option and believes that the value of an equity will go down, is they'll look at where the equity values start. Let's use $20 as an example. They will buy a contract that says, I have the right to sell you that equity at that price at some point in the future. Maybe it's a day from now, maybe it's a week from now, maybe it's 3 months from now. If you think about the implication of that contract, what that means is if they can go out on the open market and buy that equity at a lower price in the future before that contract expires, then the difference will be their effective profit. So if I'm shorting a stock that's at $20 and I'm able to buy it at $10, then when I sell it back to the other side of the trade, the counterparty of that trade, I will make a $10 profit because of that $10 drop in price. Similarly, and the risk with shorting a stock is that the potential losses are uncapped. If you think about it as the opposite of an equity, if I buy a share of Amazon, it can only go to zero. It can't go past zero. So that means I can only lose the cost basis of my investment, but it could potentially go infinitely high. There's no inherent cap on how much I can make investing in an equity. Short selling basically flips that on the head. The gains are capped by zero. At most you can do is buy it at zero and make the difference of what you're able to sell it for. The losses are uncapped. So if that stock goes up to 50 and I'm forced to buy it at 50, it never goes below 20, I'm forced to buy it at 50, then I'll lose $30 buying at 50 and being obligated to sell that stock at $20. If it goes up to 100, then I buy at 100 and I lose $80 selling it for $20. That's what's happening to the short sellers who are particularly exposed in a stock like GameStop. They are seeing the price go way, way, way above where they are contractually obligated to sell shares in the future. And so they are scrambling to try and lower that price, get in, and basically not even make a profit, minimize their losses on this short squeeze. So as GameStop started to pick up momentum, a couple things happened. Number one, Elon Musk and Chamath Palihapitiya, who are very online, they're very savvy, they're very on social media, picked up on the memes and the subreddit and these other moves and participated in the collective short squeeze. Why did they do this? Because Melvin Capital, one of the firms with the largest short position against GameStop, had also shorted Tesla, the company that Elon Musk founded, and Chamath is a significant investor in. So this is very mano a mano. You made us feel pain by shorting our company. We're going to make you feel pain for being overly exposed, overly at risk for one of these short positions. This got so bad that Melvin Capital lost $3 billion of their $12 billion portfolio, and I would estimate that they may be down even more than that. But it was so bad that Melvin had to go to larger firms like Steve Cohen's Point72 and Ken Griffin's Citadel for more than $3 billion in financing. To put that in perspective, in 1998, before the dot-com bust, long-term capital management got a bailout of $3.6 billion. So a bailout for a hedge fund that had misallocated risk, was overexposed in the midst of a liquidity crisis, was the same scale as a liquidity crisis induced by buyers, traders on Wall Street Bets on Reddit.
In a matter of days.
Absolutely crazy. So then, if we go back to last Friday, 1 week ago, the stock went up 51% on the back of Chamath's support, Elon tweeting about it. And from there, it moved from a cyclical momentum trade, an opportunity, to a meme, to a movement, and has basically just picked up momentum every single day. Other personalities, other very online characters have come out in support, everyone from Dave Portnoy to Ja Rule to Mia Khalifa to Mark Cuban.
So hedge funds are bleeding.
Yeah, hedge funds are bleeding. The price is going, it went up 51% on Friday, and it has been accelerating day by day. More people come into the stock. I list all those people, blah, blah, blah. All these people are jumping in. More retail traders are jumping in. The definition of a retail trader is not the sophisticated institutional investor with a large amount of money. And the crazy thing here is that those retail investors in this specific instance are taking the institutional investors to the woodshed. And not only are they taking the institutional investors, but they are creating unparalleled stress on the financial system itself and the clearinghouses and effectively the pipes of markets by creating these exorbitantly large counter long positions against those shorts. So crazy that Robinhood, E-Trade, Interactive Brokers, and a number of other exchanges shut down trading of GameStop, of some other equities that the Wall Street Bets subreddit was also getting into, like AMC. And that's where a little bit of the controversy has really spun up.
Yeah, we really haven't seen anything like this in terms of just regular people essentially making Wall Street bleed. And Wall Street is scrambling, hedge funds are scrambling. This is so, I hate to bring this word back, but so unprecedented that, and what's really disgusting to me is that the whole Robinhood situation, where they are so transparently shutting down something that is completely open, completely like legal. The regular people are becoming millionaires overnight because of this GameStop thing, and they stop trading because this is a system built for the big guns. This is a system built for the rich, meant to support the rich, and it's just terribly ironic that Robinhood is shutting that down.
So let's talk a little bit about the fundamentals of why Robinhood would have felt so much pressure to shut down trading on an equity like GameStop. First of all, Robinhood is free to trade on. So all those people that are trading are not paying fees to Robinhood. How do they make money? How have they accrued a multi-billion-dollar market cap as a private company? They've done that by selling their order flow and the data associated with it to market-making mega hedge funds like Citadel. Citadel, when they take these trades, and you have to think about this, you can place that trade whenever you want, and there's not immediately a counterparty taking the other side of that trade. There are large firms that basically, like a casino, take your bet and then have to figure out how to effectively de-risk or counter-risk that specific trade. It is very akin to sports gambling. Just because you decide that the Bucks are going to win the Super Bowl does not necessarily mean that at that exact same time there's someone else making the exact same size bet on the Chiefs winning the Super Bowl. And so the casino, as a medium of exchange, takes a little bit of a cut, takes a vig, but also is managing their book, managing the line, managing the structure so that they don't get overwhelmed with all the bets being on one side of a trade. If that loses, them going under. Casinos have done this for a very long time. Hedge funds have been doing this for a very long time. Citadel, because of the explosively large amount of shorts and counteracting longs in this position, was in a nearly unmanageable situation of dealing with this risk. So if you are the biggest customer of an exchange where all this risk is coming onto your platform from, I would imagine that if you are worth tens of billions of dollars, you can put a kibosh on what's happening there. And that's what many people are speculating. There are a couple other large thematics here that we need to be paying attention to. And this is larger commentary on the entire economy, on the entire kind of financial market system. The first is the idea of a liquidity crisis. A liquidity crisis is where the spreads on what someone is willing to pay and what someone is willing to sell for explode so large, so far apart, that there cannot be market clearing transactions. That is effectively what we are looking at here with GameStop, but it has implications for the entire economy at large. When there is a liquidity crisis, at some point, if you're obligated contractually to buy, then you will pay any price. But because you have to pay any price, what that means is you will have to liquidate other positions in your portfolio that might be doing fine, that might be strong, that might be completely reasonable positions. But because you have this one financial obligation over here, you have to sell over there. To think about this at a personal level, if you owed someone $10,000, the first thing you might do if you have this in immediate liquid emergency funds is you'd pay from that. If the emergency funds run out and you actually owe $20,000, then you're probably going to start selling your retirement accounts. If you sell your retirement accounts and you actually owe $40,000, then you might have to take a second mortgage out on your home. If you owe $150,000, you might have to sell that home. And that home could be perfectly fine. There could be nothing wrong with it. But because you need that money now not only are you a forced buyer on one side, willing to pay any price, but because you are a forced seller, you are willing to sell at any price. So when these characters get nervous, get concerned about the liquidity issues associated with GameStop, they don't care about GameStop. They don't care about 1 or 2 or 3 hedge funds blowing up. They are concerned about the greater liquidity implications of this squeeze going the distance and potentially exploding even higher upward.
And the other thing is, there is no reason, at this point, there is no reason why this couldn't happen again and again and again. I am skeptical that the system at large won't have new regulations and new imposed trading things. Like, I am very skeptical that the little guy is going to be able to pull this off again at this scale. But as of right now, it can be replicated.
I would go so far as to say I guarantee that some form of regulation will come out of this, because I think that liquidity crisis is yet to play out. Maybe it's already happened by the time that this goes live, but I'm saying in the next week, the explosion of a GameStop price upward and a bunch of stuff that seems blue chip. Because you think about it, if you're a hedge fund and you have some of these short positions, you're counter risking that with the stuff that is the safest longs. Yeah. That's what's in your portfolio. When we're talking about liquidity risk here and the forced selling, you're not selling your garbage. Right. You're selling your best stuff. Amazon, Apple, Facebook. Yep. Stocks like that are where the risk is if this short squeeze is seen to fruition. And by all accounts, the activity on Wall Street Bets, the amount of people that are jumping into this trade with the blockages on buying opening up, I'm expecting that to happen now. That is actually my base case.
For sure.
Second point, there's a higher VIX, and this is more of like why politicians are jumping in, AOC and Ted Cruz in agreement, Donald Trump Jr., all these characters like in agreement that this is wrong. There's higher VIX in markets from this subreddit and this trade than when people storm the Capitol.
Yeah.
VIX is a measure of volatility in the markets.
Unreal. All because of GameStop.
Yeah. And the last point here is actually, once again, a piece of commonly held investing wisdom that you hear parroted around, you don't necessarily think about the implications of, but the push of investors into passive funds. These are index funds, these are ETFs, effectively, index of the entire market that doesn't really have to think too much and is just kind of a proxy for its general year-over-year growth. Here's the issue with that. When you think about all of the shares outstanding for GameStop, you have a collection of people in Wall Street Bets that aren't willing to sell. You have a collection of hedge funds that need to buy. So if these people aren't selling, they need to go to the rest of the market and find who might be selling.
Yep.
Well, in addition to Wall Street Bets, who are not, if they hold and they have their dime in hands, aren't going to be selling. The other folks that won't be selling are the index funds. In fact, because the GameStop market capitalization, it's not in the Fortune 500, Dow Jones Industrial Average, stuff like that, but it is in the Russell 3000, if that's a market cap weighted index fund. They're actually buying more because of the growth in market capitalization. They're not making any calculations on whether or not this is a founded valuation, if it could crash in the future, blah, blah, blah. They're looking at it through the lens of thing go up, must buy. It's very robotic. It is a very unthinking, it is very mechanical. So part of the illiquidity of this GameStop equity is not just tied to some Wall Street Bets traders holding dime in hands. It is also these unthinking index funds that own more than 20% of the GameStop shares that just have no mechanism by which they would offload their shares to those Wall Street traders.
Absolutely wild. And it is still unfolding by the hour.
Yes.
Surely by the time this is published.
Some of this stuff will be dated.
Yes. Insane.
Make your own financial decisions.
Yes.
This is not financial advice to either buy or sell. We're just trying to comment on market making conditions. Speaking of market making, Databricks has achieved a $29 billion post-money valuation 27 billion pre-valuation, and then raising $2 billion. They're down, I don't know if it's like a Series G, I can't even keep track of it anymore.
Something like that.
But this is a pretty substantial growth from a $6.2 billion valuation in late 2019. So a little over a year ago, they raised $460 million in their Series F at a $6.2 billion valuation, and have now, if you want to talk about some froth in the market here, this is a substantial increase in value. And the thinking behind it is that they are probably imminent at an IPO.
Yep.
And Databricks works very similar to a company that we've covered in the past, Snowflake, which does data warehousing and helps large enterprise organizations be less in the pocket of a single cloud service provider. So Amazon AWS, Google Cloud, Microsoft Azure, Oracle, all of these companies that basically provide server space to other entities. Players like Databricks and Snowflake allow you to de-risk or depolarize on a single one of those service providers by creating what they call data lakes that can be pooled between those different server farms.
Yeah. And we will definitely link the video where we covered the Snowflake IPO. But
that one, Snowflake went public at 33 billion valuation and popped all the way up to 70 billion.
Yeah, so if that's an indicator of anything, like we have some things to keep our eye on when it comes to Databricks.
And that's why the investors piled in, because they see that pop, they're following the public markets, like, wow, if that's what Snowflake will do, our thing will probably do something similar, so let's get in now at this seemingly frothy price.
For sure.
Speaking of frothy, Calendly has been valued at $3 billion after raising $350 million. I hate Calendly.
So do I. Oh my gosh.
Not 100%, but a lot of the people that use Calendly are not empathetic to other people's time. They're super empathetic to their own time and super unempathetic to other people's time.
I've tried to use Calendly before, and I don't think it's a super intuitive user experience, but I also just, it's a very robotic way to transact your time with other people.
Yeah, and the issue is you're basically sending a link saying, here, pick a time on my schedule that works, and booking it. So the idea is we're saving time there by not going back and forth with emails. The issue is that I don't have that visceral experience of like confirming the time, or you were like, hey, let's meet at 2.
There are so many times someone has sent me their Calendly link and I've booked a time and it just it's a no-show, or it's
sending the link. That's the important thing.
Exactly. It's a no-show, or it's an incorrect. There are just problems with Calendly, I think, in that model. So, but apparently a bunch of people are using it and they're raising some money.
And here's the one thing that I love. So Tope Awatona, who founded the company, has only raised $550,000. And he poured his entire life savings into this venture. Mm-hmm. And as an Atlanta-based entrepreneur, this is certainly $350 million. A good portion of that is coming as liquidity to him for these equity positions in exchange for that stake in the company. I don't know how much of it is necessarily growth capital, but that's just an amazing story for that entrepreneur in particular.
For sure.
And he's not necessarily co-signing every single user of Calendly and their associated behaviors, but like that's pretty freaking cool.
Yeah, it is very cool. Well, that's the rundown.
Diamond hands.
Diamond hands. You said you bought some GameStop.
Yeah, just a couple, just to be part of it.
Yeah. Cool. Well, if you watch this long, make sure you like and subscribe. We post the rundown every Monday, Wednesday, and Friday. And have a great weekend.